Hey YouTube, it's Dimitri, and today I'm going to be talking about decentralized finance, so DeFi as everyone's calling it. I've avoided this topic now for, I don't know, at least a year. Everybody keeps asking, Dimitri, what is your opinion on DeFi? Why don't you weigh in on this? And then you make a video talking about a cryptocurrency options exchange kind of thing, and you turn down that job, and you've kind of been dodging, questions about cryptocurrencies. And so I thought, okay, I should make a video, but I'm not an expert on it, so I don't really want to make a video. And then I attended a conference here, and there was a whole presentation on DeFi. And of course, I'm listening, and it's like, this is wrong, this is wrong, this is wrong. And you can literally punch holes through every single point in the DeFi argument of how great and amazing and wonderful it is. So I'm not here to, burst your bubble. I'm not here to say DeFi is not a good idea. But I'm going to give you my prediction here up front. So if you just came for a quick answer, here's the quick, short rundown of this. I see markets now, so financial markets, centralized financial markets, as very burdened down by regulations, which is why it costs so much to run massive financial institutions. But again, it's all part of this really highly regulated ecosystem. It's why I think quant finance as a whole is like 10 times more rigorous than the tech industry. And I know this shocks a lot of people. But without regulations, without rules, without constraints, you're just throwing mud at the wall and hoping something sticks. And so where does DeFi come in on this? I think DeFi is basically the arbitrage opportunity that's just popped up. Regulators haven't done a lot about it. So it's basically like banking with no regulations, which makes it extremely cheap. So that's one of the main arguments we're going to talk about here in a second. And of course, when it's extremely cheap, guess what? People are going to throw money into these areas looking for loopholes, looking to avoid regulations, looking to avoid even taxes in the SEC, for example, if there are ways around this. And yeah, you might be saying, well, you're technically supposed to submit your holdings and your transactions and this, that, and the other. But there are also ways to do this internationally. And so now it gets into other issues with how do you get money in and out of the country through these systems. There are a lot of advantages of using DeFi, but it all really stems on the regulatory component here. And I have not seen anybody talk about DeFi who's actually worked in banking, who understands the regulatory side from a risk management perspective or a legal perspective. Like if I had a lawyer come on, it'd be probably 10 times better than anything I can present with you guys here. But anyway, so what I predict is we will see DeFi boom. It'll be an arbitrage opportunity. It will slowly become regulated. And we will see full circle as it becomes more and more regulated, it will actually become centralized finance. That's kind of my 2 cents on it. That's what's going to happen here. Now, cryptocurrencies in general, I am not a fan of cryptocurrencies for a variety of reasons. That being said, I do hold probably, 3, maybe 4 types of cryptocurrencies, of course, including Bitcoin and Ethereum. So I do hold them. I do have a speculative position in them. People remain, crazy for longer than we can expect. And now with our massive kind of global economic crash and the attack on the United States and capitalism and how we hate basically that of success and prosperity here, we want to basically hold everybody down and force them to be the exact same. I think it is complete nonsense. And I think this is actually driving a lot of what we see here. People are excited. They want something new. They're going to stick it to the man in the banking industry. And yet, it's just because you don't fully understand what's going to happen here. So let me break down some of the arguments I have seen for DeFi. Again, I cannot cover everything under the sun. I am not a leading expert in DeFi, but I've had my foot in the door on some of these firms. I've had discussions with some of these people that are really pro DeFi. But again, I've also come from the banking side. So I don't get any profitability income or anything from how well banks do. So it's not as if I have a skewed perspective on this from the banking side. But I'm trying to give you the reality of understanding a bank from the inside. And as soon as you start peeling the layers back and people realize what's going on, I think it shocks a lot of people oh, wow, that I didn't realize all these rules and regulations require millions of dollars for a bank just to stay compliant. So anyways, let's just dive on in here. So the big claim, the big attraction with DeFi is going to be lower overheads and broader participation. And so I see people claiming, you'll see throughout when I talk about loans a little bit, they're saying getting bank accounts is really, for the wealthy. It's for the flashy. It's for high class. It's not available for everybody. And when I say this, I'm saying this more on a global perspective as well as a US perspective, but we can look at this globally. You can talk a little bit about, okay, so A lot of poor people don't have bank accounts, for example. I know this. I worked in a blue collar industry for many years for guys that were just coming out of like high school here. So they're making like, I don't know, 10, 12 bucks an hour. Again, doing manual labor. A lot of them don't have bank accounts or didn't have bank accounts because there are high transaction fees and all these other things. This has changed a lot in the last 5 years, maybe 10 years here, where a lot of banks don't have fees or not as many fees. And again, somebody has to maintain these bank accounts. Somebody has to do those transactions, which we'll see here. And the fact is DeFi is just completely ignoring this piece. And then they start trying to hide things in like different types of tokens. And they go, oh, well, these people are just going to take a small cut because they're doing this great service for you. And people are like, yeah. But they miss the point. You're still paying a fee somewhat in this transaction here, right? There's no free lunch to be had. Again, they talked about investing too. Investing is only available to the wealthy. I don't buy this at anything. This is a nonsensical, I don't know. I'm not even going to tag it on any specific type of political group or specific type of person here, but you can do things like I have, for example, Robinhood, right? It's transaction free. Now you're going to get front run a bit here. So you're going to pay a little bit more and not get the most optimal pricing off of markets. But for somebody like who wants to just start investing, who cares? I think there's another thing called like Acorn and Stash, similar types of things. Even it takes like the remainder dollar. So say you buy something for $20.57. It's going to say, okay, you have 43 cents remainder. It rounds it up. And that 43 cents gets put into this investment account. Again, you can buy stocks. A lot of stocks are actually fairly cheap. You can buy ETFs. There are shares for 10, 20 bucks a share. So, I mean, if you got 10 or 20 bucks you can spare for the month, you could buy a stock. So I don't buy the whole nonsensical thing, the argument poor people don't have bank accounts because it's too expensive. I don't buy that poor people don't invest because it's too expensive. It's unavailable. It's only for the wealthy. These are just plain simple lies. It's just really comes down to a cultural difference here from what I've seen. That like if your parents don't invest, they don't get excited about it and they're not saving and they're not really doing these sorts of things. You're just not going to do it, right? You don't see the importance of it. You don't see the value of it. I can say this coming from a variety background of different stratas within the wealth distribution, here in the United States, as I've gone through many different areas of it. But again, it comes down to just habits. Like some of my poorest friends, they buy coffee every day for like $5-6. We go out, they buy energy drinks for, $2-3. Typically we're going to like 7-Eleven or even like, I don't know, other places where they're like $3 easy. We're not even getting them on sale here. So if you don't know, you can get them for like $2 or $1 something if you go to Kroger. Anyways, and then they're buying cigarettes and chew and like, there's all these things they're doing that are just wasteful habits they have. And I'm not knocking it saying you shouldn't do it and like, I'm going to control you because realistically I'm a libertarian. You should be able to do whatever you want. So I don't really care if you waste your money. That's up to you. But don't bring out the lies here that they don't save, don't have bank accounts, and don't invest simply because it's too expensive, because those are all nonsensical lies, at least in the US here. Now, if you go to like a third world country, you might not have a bank available to you. There might be really high fees. Again, I don't know exactly how you would operate with like, I don't know, some of these apps like Robinhood internationally, because you're not a US citizen. I don't know if you have access to these exchanges and how that works. But in general, I don't buy the nonsensical lies here that it's just too expensive and this is going to solve all of your problems. Now, the second point here is going to be the use of automated market makers. This is like the big draw for this. This is smart contracts with Ethereum. Everything's executed in an automated fashion. It gets rid of banks. Like that's the whole key here. So first off, it assumes there are no market failures and there's no manipulation. So as someone that works in the financial industry here, I work a lot with models that try to prevent manipulation here. And what do I mean by this? So, how to go about this? There are different parties involved in different sorts of transactions in banking. So for example, people that are selling mortgages to different clients, people that are selling cars, for example, like car dealers, there's always an incentive for them to get you into that car or to get you into that house. And so at any cost, they'll do it and they'll manipulate numbers behind the scenes because they know that a bank is using a model to predict whether you're going to be eligible for like a credit card or an auto loan or something else. And if you're a third party that's going to be getting people into these products, you don't really care if they default or they're in terrible financial situations. You don't care because you're not going to be the one in there. You're just looking for that cut to get them into that product here. So yeah, banks build models to actually prevent this and target this and look for manipulation within different parties and transactions here. It also assumes no model failure. There's going to be automated market makers. there are going to be big players in this. If it is not regulated, trust me, there are very, very large, wealthy individuals, hedge funds, and firms that can move these markets in different directions and do market manipulation. This is exactly why the SEC exists. It's one of its main core responsibilities to protect against insider trading, again, market manipulations and these things. They're extremely hard to prevent, to digest, to understand. It's not like, I run out and I have a bright red flag or something. I'm waving it around and you can see me and I'm on the sidelines and I'm about to manipulate markets. You can get very tactful in this, especially with automated programming. So algorithmic trading, for example, you can get in and do things that aren't legal. So again, you need some sort of regulation to prevent that, because the person that ends up losing in these situations is not going to be these big hedge funds. It's not going to be these big wealthy individuals. It's going to be the little guy on the bottom who, pulls out their cell phone like me, and they're buying and selling Bitcoin, or they're going to be using Bitcoin to purchase, daily products, if we can get it to do that, or Ethereum or whatever. And so the people that are going to be losing are going to be the little guy. It's not going to be these big firms that are getting screwed when you have market manipulation. So regulations protect everybody. It protects big firms as well, but it really protects those that are using dollars on the bottom here. And so you need regulation to do this. And I hate to say it, because regulations often cause inefficiencies, which we all know, especially coming from the banking side. But you need it, right? You guys, you need that. The other claim here with an automated system is it's going to be interest. How is interest going to be earned if there's no fees, there's no interest on this? Right? This starts to raise a little bit of a red flag here with me. And I'm like, but you realize this automation occurs on servers. You still have to have a computer server. And you still have people that maintain that. And there's, as we'll see here in a second, there are security issues with these servers as well for hacks. So who are you paying to do this, right? No one's going to do this for free. And people go, oh, it's automated and there's people that are watching. But another criticism we'll see later is you can't reverse the contracts either. So there's no governing body to say, player A screwed over player B and misled them or created some sort of false transaction here. How do you undo that? How do you find it? Right? I mean, again, you're going to need people to monitor this and to look into this. And this is going to add fees on top of it. And so I can tell you at banks here, we have entire departments that work on this, right? When a bank gets hacked and there's an information leak, they have to post publicly, there's been some information leak. They have to tell you what has possibly been leaked. There's whole investigations into this. There are different regulatory agencies that are responsible for following up on this. If a bank has a leak and they don't say anything, you will face very, very severe fines, because guess what? You need to allow people to understand you could be hacked, your money could have been stolen, or there's some other issue here. So again, you're going to have to pay someone to do that. And moving fully digital makes this a little more challenging in many ways, because it gets more complicated, especially when you have global markets here. It's not just in one country. So we're going to have to get higher regulation on this, and you have to watch things kind of move around. And this leads me to talk a little bit about different sorts of regulations and funding issues that we face in banking here. So almost every employee at a bank will go through what they call anti-money laundering and BSA, which is the Bank Secrecy Act. These you can Google these. You're going to double check me on this, but we go through this training and it basically talks about a few different things. So one, money laundering is a huge business, and banks are required, at least in the United States, and of course in probably every developed country in the world, you are required to actually prevent money laundering. So money laundering is where you end up taking cash from some sort of illegal transaction. I think that's called placement, where you get it placed into the financial institution systems, and then you actually break this up into different transactions and you layer it through the system to hide the source of these funds. And then you end up somehow getting this back out here. This is why, for example, we'll throw an example, drug lords, for example, end up buying lots of real estate and cars and different things that are really expensive, is because you get the cash, you try to get it into a financial institution, you spread it across a variety of different accounts, different banks, for example. It makes it really hard to track. And then you come in and then you end up buying things with it so that it looks like, oh, it's a legitimate business and this owner bought a house. But it's my 15th house, for example, here, right? So they do this to get the cash from the profitability. You can't store all this in a bank account, right? Banks are going to look at you and go, this guy's got, $500 million sitting in a bank account. That seems kind of suspicious, right? You need to figure out how to break it down here and hide it. Again, banks are responsible for actually preventing this. They are responsible. They will face fines and penalties. And I believe you can even face jail time as an employee if you allow this to happen. So there has to be some sort of monitoring and AML component to this. Bank Secrecy Act, I believe, if I recall this correctly, we have to verify the identity. So it's called Know Your Customer, KYC. This is also more training. You have to know your customer to prevent, again, money laundering and fraud and all that. There's also terrorist financing. So terrorist financing, again, is a little bit different than fraud in the sense of like AML, because terrorist organizations often have some sort of underlying goal they're funding or financing here. So they're not looking to make a bunch of money. They're usually not in the business of just making money to make money and live a high life. They have some sort of underlying moral, ethical code that they're trying to follow. Whether you hate a specific group of people, or I don't know, you have some sort of extremist viewpoint and you're trying to rid other people off the planet. Again, we don't want people funding these organizations. We don't want people donating to these organizations. This is why the United States has all kinds of rules and regulations in which countries you can and can't work with money coming in and out. For example, I had students that I'd worked with that came from Iran. And so when they pay tuition in the United States, they go through a little bit more scrutiny because there's all this money coming into the US here. Now, again, of course, it's legitimate in the sense they're paying for, tuition and everything. But there are different rules on different countries. And even internally inside the United States, we have entire programs that vet people and make sure we understand what's going on and that we're not funding, terrorist organizations here. So all these things, again, they're ignoring here. These takes entire teams of people, right? You can't just say, oh, it's going to be automated. Like, I'll just know that it's coming from a legitimate account. Yeah, that's not quite how it works, guys. So you're going to need people in the system to do this. So you have to hire more people here. So we're going to need staff and employees to manage these and to monitor these and to build models for these, to predict these, to prevent these. And eventually regulations will come and it will force DeFi to actually do this. So again, I hope you're kind of seeing here, we're layering on all these issues, and to solve these, we end up needing departments and people to do this. And when you think like, oh, you need a person, like you might be building an anti-money laundering model. And then you have to have people that are going to implement and program that model. And you're going to have people that are actually using that model and monitoring it. And you have to have people on like the teller side all over the country and the world that are operating, that do this. So even if it's automated and like smart contracts and Ethereum here, you have to have a way to be able to like figure this out, right? Who is using money for what? What is it being used for? And is that person basically a legitimate person, or are they fraudulent? Are they made up person? Like, you need something here. So this is going to add more costs on top of DeFi as regulations kind of get added in for this. And that leads me to talk a little bit about the governance tokens here. So I've heard people talk about, there's going to be governance tokens, and, basically it's going to be a group of people that are going to have these tokens, and you can basically vote on things, and it's going to provide some sort of governance framework here. And, again, it's completely decentralized because everybody has tokens. Well, that's fine. Okay, I'll say, okay, that's fine. But you can buy and sell these tokens themselves. And I believe from what I've heard about this, they will pay some sort of interest or payment for people to actually do the work to do some of the governance here. So let's say this ties into the anti-money laundering and all that, and the governance token holders are responsible for this. Again, they would be legally responsible. So this is not going to be something that's like fun and easy. You're going to have to like add some responsibilities, and they're going to have legal liabilities against it. And so it's going to be an issue. The other issue, though, is that you can sell these. From what I've heard, you can buy and sell governance tokens. What would prevent, I don't know, some massive wealthy individual from coming in and buying all the governance tokens and then just not governing it? Right? Like, I don't think people think this through. They think like, oh, well, the masses have all this money. Well, you don't realize someone like, I don't know, George Soros, for example, could just swoop in and buy out all of your tokens. And then one guy's got control over the entire system, and then it's not even decentralized. It's going to just be like manipulated and controlled or ran by a specific group. And this leads me to the issue of a country. What if a country just buys all of them out? Then what do you do? I don't know. It just doesn't seem like a very good solution. Again, what are these governance tokens actually doing? How are they preventing things? Are they responsible for building models? Again, verifying transactions, like, okay, it's a transaction, but is there a know your customer piece here that you're going to be monitoring? And then this leads to the issue on top of this. So know your customer is the requirement for banks. For example, when you come in and open an account, you have to provide your social security number in the United States. You have to provide like ID, state ID or federal ID, passport ID, something like that, in your name and your address and all this information, so we know who you are and we can verify who you are. Now, again, there's people that try to fraud these sorts of things, right? If you're committing, money laundering or something, you have to figure out a way to get around this. Now, again, right, who's going to store all these social security numbers? I sure hope mine's not, just stored on, some sort of global server. And if someone buys a governance token, they can pull me up and look at my, my personal information here. Like, this is a massive security fraud issue. I just don't see how DeFi is going to solve this unless they start adding in more and more and more layers and more scrutiny and eventually come to a centralized framework. So this is one of these issues I just think is like, yeah, you tacked on governance tokens as a nice, pie in the sky idea, but it's not really going to solve a lot of issues with governance of actual transactions. And again, I don't think DeFi really fully understands terrorist funding as well as like money laundering very well. So these are things that you don't typically think about in banks, but it's a service they provide to you whether you use it or not. You're actually ran through these systems and they are monitored to make it a safe, operable system. And hopefully, you don't get hacked or frauded and money stolen on your account. And also hopefully, these banks, institutions, or even DeFi is not funding terrorism across the globe. So those are some issues I have with the governance tokens. Now, let's talk a little bit about loans here, because this is touted as touted, whatever you want to say here, as like this amazing equality, thing. So the far left's like jumping up and down, yay, let's do DeFi. And they're all really excited thinking this is going to make it fair and equal. And banks are out somehow discriminating against people, which is not true, at least not in the US. And I'm guessing not in most of Europe and other countries around the world too that are fairly well developed. But they say, okay, you're going to have loans and you're going to have interest rates, and interest rates are going to be set based on supply and demand. Okay. Like, this sounds like an economist, just like, an undergrad economist, just like making things up. Like, I don't think you understand how loans and interest rates work. So let me just explain this briefly if you haven't watched my other videos. Interest rates are set based on individual risk here. Okay, this is why, for example, if I go down and get a loan for, say a new car, and you go down and get a loan for a new car, our rates are going to be different. And it depends on individual, characteristics here. Like, how much money do you make? How much debt do you have outstanding? Basically, we're trying to figure out what is the probability that you will pay back the loan here. And so we actually build models and they calculate something called expected loss. So EL. Your expected loss is a simple equation, which is going to be expected loss equals probability of default times loss given default times exposure at default. So PD, LGD, EAD. Again, we build statistical models typically for all three components. We run all this together and all these variables in the model, for example, how much money you make, where you live, well, not where you live, but how much money you make. There are other things like your FICO score, for example. These sorts of things make it into the model. We're just trying to figure out like what's the probability you will pay back the money. Okay. Now, if you're really likely to pay back the money, we give you a low interest rate because, there's not much risk there. I'm going to get paid back either way. And in an open, capitalist system here, banks are competing for those rates here. So different banks will give you different interest rates here. So even, for example, in submarkets, let's say you're subprime. So someone that is extremely risky, you can go to different banks that specialize in subprime. Yeah, and these different banks will give you, competing rates because they're trying to beat out the other banks for a good rate for you. Good terms on your loan, for example, for your automotive, purchase here. So the capitalist system works very well. Again, supply and demand of rates based on the whole market as a whole. This is just ridiculous in itself. I mean, imagine you give everybody the same interest rate. People that are really risky are going to default and just not pay their loans off, but they're going to keep their cars. And again, who's going to repo the car now? Like, there's just missing holes and pieces in here. Again, banks are responsible for this, guys. When a bank makes a loan, for example, like an auto loan, and you don't make that payment, the bank has to pay somebody to go repossess the car, sell the car, bring the money back to the bank so that the bank can be made more partial. Again, you're not going to be made whole most times because you've defaulted, unless the car's worth, for some reason, a lot of money. But again, you need someone in that rink to make that happen here. And rates should be based on your individuals. Now, let's say you're a really, really, great individual and you have great credit, and now they're giving you a high rate because, it's the average rate. You're not going to get a loan from anyone in DeFi. You're going to go, to traditional banks to get these loans here. So you're going to end up with a pool of just bad, poor financial candidates, terrorists, just not good, seedy individuals here. Maybe even like college students, for example. Maybe you're viewed as way too risky for a bank to take a loan on, for example. And maybe you're not that risky. I don't know here. But it provides a competing component. But again, a lot of the people viewed as really, really risky and not even subprime, but like, it's going to be people that are just shady and have no identity and can't prove who they are. These sorts of people are going to gravitate towards these loans and markets here within an automated DeFi system here. So it's going to be extremely hard to do. So again, it ignores individual risk. And then my other issue is who takes the loss on these loans, right? Like it's really easy to say. So again here, let me go down to my next point here. There's the claim that DeFi, all loans are collateralized with a crypto asset. And so basically there's not going to be any losses and it's going to be this magical system. Okay, so first off, all loans have a risk of loss here. That's just how loans work. That's how the world of finance works. That's why you're paying interest, because there's a probability that you will default here. There's some sort of risk. Again, now, this is the weird collateral thing I don't get. This is basically like a pawn shop, okay? DeFi thinks they're a pawn shop. They think you're going to run out there and, I don't know, say you have a bunch of Bitcoin just sitting on the books. Right? This mass, I've got like $1 million in Bitcoin. And I need a house. So what I'm going to go do is I need to make a loan for US dollars. And so I'm going to give you all this Bitcoin to hold on to, which has like $1 million value. And I'm going to go out there and buy a $500,000 house. So I'm double collateralized on this. And I'm going to go and trade this for dollars. I'm going to buy the house. The question is, why do you need the loan? If you're 100% collateralized, you don't need the loan. Like people that want to buy a house, like when I bought my house, I didn't have $300 and something thousand just sitting in a bank account, which I could just run out and just like write a check or something, or have big briefcases full of cash and give it to the bank here, right? If I had the money, I don't need the loan. So when you need a loan, you're not going to have the things to collateralize it. Now, collateralizing with cryptocurrencies is implying in some ways that cryptocurrency is not very liquid and you can't convert it back to US dollars. That seems kind of odd too, because that's not really the case. And again, it kind of goes against the whole DeFi structure here. So they're saying, this is what the presentation I was watching was talking about. Collateral basically can't be withdrawn. That makes complete sense. It guarantees they won't default. And then it says default is liquidated by others who will pay off the debt or part of it for the collateral. Again, why would you take the loan though? Like, there's no reason to take a loan if you don't need the money, right? You take a loan because you need money and you don't have it. And if you can convert Ethereum into Bitcoin, into US dollars, into British pounds, into whatever else, there's no really reason why you would take that sort of loan unless you're doing this from a speculative bet perspective here. So the whole loan financing piece here for me just makes no sense. Again, why do pawn shops, so I compare this to pawn shops, why do pawn shops make sense? Because you went out and you bought something. Let's say like you bought a gun, or you bought, I don't know, you have a car, for example, and you can use the title of your car. And you say, okay, hold on to this asset for me. You are now the official owner of the asset, which is the collateral. I need cash because cash is more liquid and I can pay my rent and buy food and other things with it. Now, the whole idea here of cryptocurrencies is it should be that liquid as well. So trading, it's like saying, oh, hold on to my $100,000 while I borrow $100,000 for you or less. Like I'm going to borrow $50,000 from you, I'm going to give you $100,000. Yeah, it just doesn't make sense. I mean, for me, it baffles me how this has become an idea here. Maybe I'm missing something crucial. If I'm missing something crucial, please put in the comments and put, Dimitri, regarding loans, this is why it's important. But again, if it's as liquid as cash, I don't know. I don't understand. If you can collateralize the loan, you don't need the loan. People aren't going to take it unless you're, again, speculative betting here. Okay, and that leads me to yield farming. So let's talk about yield farming. I had never even heard of this. I didn't know this was a thing until this presentation, and I Googled some things on it. They threw out some names like Harvest and Yearn Finance. Again, these are firms that I guess are doing this. It allows individuals to invest in firms looking to arbitrage the crypto markets. And so what the idea here is that instead of having these massive hedge funds chocked full of, old rich people, instead you would have these firms basically where everybody can participate and everybody can put in a little bit of interest and money into these firms, and they're going to go out and do yield farming, and they're going to look at the arbitrage here. So again, I get this, right? We're going to have inefficiencies in the market, and we want to pay someone basically to do this. There's going to be some sort of fee for it. Again, we don't want to pay people though, because it's going to be free and it's not going to follow, traditional centralized banks. And so it's going to be this way to capitalize and take money based on arbitrage opportunities while keeping the prices, competitive and kind of realistic here. So I hope some of you are thinking in your head, Dimitri, this already exists. And it does. It's called a hedge fund. So now why is yield farming different than hedge funds? Really just comes down to regulation here. So if you don't know, to invest in a hedge fund, you need to have $100,000 in capital, least last time I checked. You can Google and figure out what the exact dollar value is, but it was $100,000 in liquid assets, and I believe it excluded your house. So what it does is, so for those of you that don't know, hedge funds are extremely risky. They're not like these well-stabilized funds that make billions of dollars and churn out, lots of money. There are some that do that, but again, they can only manage so much capital due to market constraints and strategy constraints. And then on top of that, right, they have people that have been in this for a long time. They don't allow new investors in. And so at the end of the day, what ends up happening is, a bunch of rich people end up making more and more money. Now, that being said, that's a very, very few amount of cases here. There are tons and tons of hedge funds that go bankrupt every couple of years. And then the same guys open new hedge funds and they take more money. And then they keep doing it over and over again. But realistically, a hedge fund is a really, really risky investment strategy where you're trying to arbitrage markets and take advantage of different kind of, unregulated forms. So hedge funds in a way are somewhat less regulated, which is why a lot of investors kind of draw towards them. There's less kind of rules around it. But again, yield farming would be like the zero regulation version of a hedge fund. And I can't imagine regulators say, Tom, Dick, and Harry down the street here, these average people, let's allow them to throw a bunch of money in here and gamble on it. And let's hope they get rich off it. And when they don't, they're going to cry and complain that the bank screwed them. The finance industry is evil and everything else. Now, again, I'm not saying that we should have a limit of 100,000. I'm not saying that we should have a limit of 50,000. I don't know where that limit goes. I don't even know if you should even have a limit, right? Sure. If they want to gamble with it, let them gamble with it. There are different opinions on this. I probably lean more towards the camp of let's have less regulation with hedge funds in the sense of who can put money in. But that being said, I'd probably lean more towards how they actually do some of their transactions and businesses because they're way too risky in many situations. But again, here, they're individuals making individual decisions as long as you're not, doing illegal things, Ponzi schemes, those sorts of things. I don't see any issue with it. But again, yield farming, it's just a hedge fund. I don't understand how it's any different here. Again, maybe I'm missing something crucial. Maybe put it in the comments below. But it's not really any different here. So I don't see any advantages with this. And then finally here, let's talk about risk here. So I work in risk management. It's my whole crucial job. Again, you're going to have investment risk in this no matter where you come from at. So no matter if you're doing yield farming or you're trying to convert dollars into, Bitcoin or Ethereum, and you think you're going to make a bunch of money and then you try to pull it out, there's always some sort of risk when you transact between different currencies. So even if you went from like US dollars to pesos to, British pounds to lira or something else, they're all going to have some sort of risk in here. So you're going to have risk no matter what. You can't eliminate that. Cyber attacks are possible. And I think this is being just ignored everywhere. So banks have millions, if not billions of dollars invested in teams to work with, cybersecurity, technology, make sure you can access your bank accounts, but prevent people from doing that, preventing fraud, preventing, information theft. We talked about before with Know Your Customer and some other things like that. But again, cybersecurity is a massive issue here. I'll mention here too, there's a hack called the Cream hack, I guess. It was like $130 million in losses. I remember it was like Iron Mountain or whatever the big hack was with Bitcoin. Again, when these things happen, there's no way to get the money back, guys. So there needs to be more transparency. There needs to be more regulation, but at the same time, right, to prevent a lot of theft and manipulation of, different types of transactions and to hide these sorts of things. You're going to need some privacy as well, and you're going to need someone to manage that and pay them to do that. You can't make it open source. So that's just my 2 cents on that. And for open source as a whole here, I think it's great. I think it's nice that the younger crowd thinks everyone can do things for free. We'll make it low cost and we'll automate things. There'll be no problems at all, except for we see massive issues with automation across the board in every industry, including tech. But when you talk about finances, you talk about your livelihood, you talk about everything you've saved up and earned here, you're going to want an expert to really dive in on this. You're going to want people that are really managing this. And I know people don't think about this when you open a bank account, right? You think I just need someone to store my cash. I'm going to have quick access to it. I'm going to pull out my debit card or my credit card and I'm going to buy stuff. Or I need a loan, I'm going to go down and get a loan. But you're not thinking about all the security measures, all the technology that goes in behind these sorts of things. So, I'll give you an example here with credit cards. Fraud detection is amazing on many credit cards now. They will send you a notice and you will see, you get this weird transaction, like you're buying 15 pairs of tennis shoes at 2 a.m. and they flag it and they stop the cost and the transaction. And then you can go in and say, oh, of course, that was not me. Or maybe, I don't know. Yeah, it was me. I had an amazing Christmas idea or something. I don't know. But there's all these technologies that add up here on the cost of this. And again, I could nail home a lot of these different things here, but there's a lot of problems DeFi can't solve, and you need some sort of centralized grouping to do this. I think it's ignoring, again, the regulations and how much it really costs. So I remember like in undergrad, we talked about the Sarbanes-Oxley Act, which is a financial reporting act. I think it was like an estimate of $1.2 million is what it costs a firm, so a business in general, to meet the SOX, so Sarbanes-Oxley Act. When you start throwing in regulations on like, I don't know, anti-terrorism and BSA and like CCAR, for example, capitalization and all these sorts of things, you start to add in millions and millions and millions and millions of dollars. And you have to think about every firm has to have a system for this. And again, you don't want these centralized to the point where it's like your information is just being passed around to whoever, which is kind of the open source method here. So how you solve these, I don't know. But when I saw the presentation I'm talking about, or when I hear people talk about it, they often mention at the beginning, oh, regulation's a big deal. And they like wave it off as like a $10 million problem, when realistically, like it makes it significantly more. And the last piece here for me to wrap up here, one of the other components and assumptions I think that DeFi is making is we have really, really smart people in DeFi, and they're going to solve these problems, and they're going to do it without all the regulation, and they're going to create a whole automated system, and it's going to disrupt the finance industry. And really the reason we know this is because we're smart. We're really smart people. But the assumption you're making here is that A, banks can't hire smart people, and two, banks don't have smart people. Now, again, you don't see this coming from the outside, especially if you've never worked in a bank. There are entire IT departments. There are entire, model development and quant finance departments that develop models for automation, that develop models that predict things, and there are teams that validate these models and test them and go through regulatory scrutiny on this. There are entire teams of people you don't even see at a bank that you don't even know exist. And even for myself, I had a finance degree and a master's in financial engineering, which I started and then transferred into applied economics and an economic perspective. I never knew a lot of the departments that are inside of a bank even existed, because I've always just been a customer, and I took all these corporate finance classes and investment banking classes at, highfalutin business schools. But at the end of the day, you don't see all these layerings and all the costs behind this. And I think this is where I don't think DeFi has a bad intention. I just don't think they see the reality of this. And even talking from like crypto trading, and all this stuff, it's illegal in the United States to do, for example, option trading, because you have to be licensed through like an SEC dealer. And I think Uniswap is going through a bunch of headaches and lawsuits right now. Again, I don't know all the details of this. I've been following, all these different things with it, but they're going to have to get regulated. There are a lot of other issues out there, and those issues actually protect you as a consumer who uses the products. So it's not as simple as like, we're going to get rid of regulations, which are ridiculous and nonsensical regulations, and we're going to do the right thing, and magically it's all going to get automated. So I just think there's too much hand waving. And a last kind of warning note here on cryptocurrencies, I don't really see a lot of additional value of using a cryptocurrency over $1. You can say, oh, there's scarcity and they can't print it and whatever. Okay, well, technically gold and silver are far better because they have an actual usage outside of just being a currency. They have a natural constraint as well. So anyone could say like, oh, Bitcoin's, capped and limited, Ethereum's capped and limited. You could always have someone that could adjust the system and fudge it, or have a big voting cast that changed the total outcomes of this. The piece that really worries me, though, is governmental control, which I know is the whole point of why DeFi, in a way, is really excited. You can kind of get away from the regulations. At least that's the theory here. But what scares me is that, for example, in the United States, we are just deteriorating the dollar down to nothing. And I know people say, oh, they're printing money, and I know technically it's not printing money, but we take out massive and massive amounts of loans. Again, they mentioned China a lot, but Japan is also a massive holder of the United States debt. But the concern is that the United States, if you look online, the Federal Reserve is actually looking at creating another currency for the United States, a digital cryptocurrency. Now, when I use my credit card, I never transact in dollars, right? I swipe it and it just takes out dollar values, but there's no currency swapping hands here. So we're already digitized pretty well. And there's a lot of security from the banking side that goes into this, and regulations and everything we talked about. Now, if the United States wanted to just basically print money, they can do that. It's part of the rights they have. But they could devalue it, and we could have stagflation. And now as we're kind of seeing inflation on the horizon and it's getting bigger and bigger, and they say, oh, it's transitory, it's going away, it's not a big deal, guys. Don't worry about it. Trust us. We have your best interest at heart. They don't have your best interest at heart. The government never does. But the concern is what if they just crash the dollar and they just create their own cryptocurrency? There's a guy talking about, this, but talking about it from this really positive perspective on, the government would have this one centralized account and everybody would have an account because you're a US citizen, and we would track these dollars and it would be a crypto exchange, and it would all be, within the United States as cryptocurrency, and we could, prevent all this other like trading of Bitcoin and Ethereum. Guys, the government's looking to crush DeFi and using it though as a leveraging point somewhat. And again, I don't know if they're actually doing it, but there are discussions going on about why they would want a cryptocurrency. There are professors at universities that are pushing for this as well, economists. I have not seen a massive advantage on having a cryptocurrency. And even a lot of those advantages, like getting away from governments printing money and all the out of control Federal Reserve policies, if they start doing their own cryptocurrencies and they have final control, which government always does, we should be looking at how do we shrink government and have less government, not how to create a new currency and then allow the government to crush that currency with another digital currency they create. So those are my 2 cents, at least on cryptocurrency at the end here. Anyways, thanks for watching. Thanks for listening. And as always, until next time.